Hello and welcome. My name is Benoit Paliquet. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the 2022 year-end review video. As always, you can pause, slow down, or speed up the video using your video player. Thanks again for watching. And let's take a look at some of the events that preoccupied investors during 2022. Thank you for watching. Now, 2022 was difficult on investors. In fact, there's nowhere to hide, and I'll show you that in the next slide. Investors reacted to a new reality during 2022, and the question is, for 2023, is there more to come? Now, our answer is we don't make calls, but let's look at the most probable scenario, and it's that it's almost over for the investor class. Maybe another downside, maybe some softness in the first quarter, but by and large, most of the damage is done already. It doesn't mean the markets will rebound necessarily, but in terms of the grinding downward march, we feel most probable scenarios that the worst is over. However, and it's sort of like driving through a snowstorm. You kind of never know it when it's going to end. You know when you're in the thick of it, and it's only slowly over time do you really realize that things are getting better. Small incremental changes. But this is where Wall Street and Bay Street will differ from Main Street, we feel, where in the most investors have been put through the ringer in 2022. Main Street is about to go through the ringer. So let's dive into that concept a little bit more. So for 2022, there is nowhere to hide. So the S&P 500, the S&P TSX Composite, so that's the Canadian market, was down almost 6% for the year after a strong fourth quarter, up 6%. So at the end of September, we were staring at some pretty dismal numbers in terms of performance for investors. We had most classes or most asset classes had a decent return in the fourth quarter. So for the year, the larger the component in technology that you had, so if you compare the Canadian market with the NASDAQ, the larger the component was in technology, the bigger the downdraft was. So for the year, the NASDAQ is down 28% in Canadian dollar terms. The S&P 500 is down 12% in Canadian dollar terms. And Europe turned in a pretty decent number after a very strong fourth quarter. Only down 3% for the year of 2022. Emerging markets, including China, were down 17%. Our dollar, the U.S. dollar had a really great year, meaning our dollar went down, and bonds turned in a negative number. In fact, it is the first time since 1969 where equity markets and bond markets fall at the same time. Commodities, including oil, did well, as did gold, and interest rates have gone up, as we all know, and we'll talk much more about this later in the video. With the Canadian government bonds, the one-year maturity paying 4.6% to investors at the close of 2022. The 5-year yield is 3.4, and the 10-year yield is around 3.3. GIC rates are now at or close to the 5% range, which is something we haven't seen in many, many years. Back in the good old days, when traders wore suits and took a train or a bus to work, and they went in big office towers to meet with portfolio managers and analysts in their offices, or they'd meet up in trading floors or over afternoon drinks or maybe even the gym, and that wasn't considered a chore. Anyway, I'm digressing here a little bit, but there was a saying that used to make the rounds when I started anyway, that bear markets are slayed when the generals are killed off. Now, I'm not sure you can repeat this these days, and it's certainly not PETA approved, but the point is a good one. If we look at the performance of this year, so this is the first time I show this table. This is the worst performing stocks for 2022. These are the bottom members of the S&P 500. Now, typically, this chart is made of names that no one had ever seen. Well, what we're seeing here at the moment are some of the best performing, some of the stocks that had some dramatic givebacks, but that used to be the darlings of fund managers and do-it-yourself investors alike. So we've got Tesla, Meta, which used to be called Facebook, PayPal, Carnival, Stanley, Dish Networks, Caesars Palace, CarMax, Expedia, Seagate, Netflix, NVIDIA, West Pharmaceuticals, Amazon, Charter, Salesforce. These are giants that have been slayed. You only see this at the end of the bull market. Down 70% on Generac, Match.com, even Salesforce down, basically 50%. These are massively large companies, and the downdraft has been unrelentless. Last quarter, 2 quarters, 3 quarters, 4 quarters, absolutely relentless. So that's why this thing really sticks. If we move over to the Canadian market, Shopify, Canopy Growth, BlackBerry, Lightspeed, Ballard Power, Canada Goose. These are all names, Onyx, these are all names that really were the darlings as well on the Canadian side, north of the 49th parallel in terms of do-it-yourself investors or professional managers as well. So these generals have really, really taken on the chin in 2022. Now, some of you might think, oh, well, Ben, this is, there might be a comeback in store. Maybe we just double down on these. Maybe we should buy more. So let's go through a history lesson. They always come back. So what you've got here is the Microsoft chart going back to 20 years, basically going back to the last peak, the last tech boom, the end of 99, beginning of 2000. Microsoft peaked at, let's call it, $60 or so. It didn't cross $60 again until basically late 2016, early 2017. That's a 16 or 17 year wait, depending on how you do the math. Now, granted, the stock has been absolutely on a tear since then, but we call this trading in a box. The box was 17 years in length. Doesn't mean you couldn't make any money. You could trade this stock actually quite well, or you could have bought it, and this is a downturn into 08, 09. There are times to buy this, but if you bought at the beginning or at the last peak and held on thinking these things are going to come back to your cost price, in the case of Microsoft, you waited 16, 17 years plus. In the case of Cisco, the stock is still not back. It peaked at almost $80, slightly over $80, same time frame. 20 years later plus, the stock is still not above its peak. Investors during 2022 were worried about this three-headed villain monster. So let's identify each head of this villain. The first one was interest rates. Now we're going to make a case in the next few slides that interest rates, or the bulk of the move upwards in interest rate, is behind us. There might be some more, and in fact, we do believe there are some more rate upward pressure on interest rates coming, but most of the damage is done. Investors are now worried or thinking about economic growth or a recession. Now, the narrative, or the most commonly accepted narrative, is that there's going to be a recession sometime to mid to late 2023. And the labor markets, there's been massive upward pressure in the labor markets in terms of cost, or what's called labor inflation. And this type of labor inflation, this type of inflation, is actually very difficult to stamp out if you are a central bank. So investors right now are focusing on two of the three heads of the villains. So why do interest rates matter so much to investors? I promise this is the only math you need to remember when it comes to this video. So basically, finance is based on a few important mathematical formulas. This is one of them. And if you remember one, this is the one to remember. Basically, the present value of an asset, let's call it a stock, a bond, a business, it doesn't really matter. It's worth today whatever the future cash flows of the business will be, or future profits, if you will. And there you divide each unit of the future value or future profit, and you denominate that and bring it in today's values by a denominator. And you use interest rates, and you use time. N being the function of time, R being interest rates. And so it's important that the R, if interest rates move up, meaning the R gets bigger, you have a smaller present value, all else being equal. So investors, when they see a larger R or fretting about a larger R, will immediately sell down the value of the assets based on what their expected rate of return will be, or what the posted interest rate of return will be. And now the other important concept, when R goes up, present value goes down, being the first concept to remember. The second one is the more end periods you have, the more time you have, the more this impact is important. So technology companies or long-dated bonds, which have a large N, meaning the future profits over a long time period, well, that concept of the denominator increasing its numerical value has a larger impact, meaning tech companies and long bonds are more adversely impacted against a rising interest rate environment than, say, a boring telecom company that has a big dividend and not a whole lot of growth to it. Our viewpoint when it comes to interest rates is that we're simply going back to the future. We're going back to where interest rates were prior to the Great Recession of 2008, at the very least back to where we were pre-COVID. So what I've got two short charts for you. The first one is the U.S. 10-year yield. I show this every video, and I've gone back 20 years. And interest rates for the first decade, if you will, were around the 4 to 5% rate. And then the Great Recession hit, and interest rates went basically on a one-way trade all the way down, and they bottomed at the bottom of COVID. So the 10-year rate back then was, let's call it 60 or 65 basis points, meaning an investor accepted to make 0.6% every year for 10 years for loaning money to the U.S. government. So we went back and looked at what that 10-year rate used to be, and we found data from Professor Schiller over at Yale University, who publishes this data free of charge to anyone who wants to look, and he's got data going back to 1871 on the U.S. 10-year yield. And we went back, and there are periods where basically you can eyeball this, and you say, you know what, on eyeball it's around 4 to 5%, or 4 to 6%. And in fact, the chart going back to 1871, the average is 4.46. So let's call it 4.5%. And what brought up this average is the period, the high inflation period of, let's call it the 70s. And then interest rates on the 10-year peaked in the mid-80s and have been on a one-way trend down. So one argument could be made that we're just moving back to the trend line. Interest rates are moving back right now. They're at 3.71 at the end of the year. And if the trend is 4.5%, we've got maybe 80 basis points left to go in terms of a rise in interest rates. So while many investors started investing 10 years ago, 12 years ago, when interest rates were sub 5%, if you take a wider lens, really 5% is not a number that made the economy not workable. Something to remember, perspective is everything. So if interest rates are almost done roaring, what about the other villain? A recession. So what I've got here is the S&P 500 chart, and the red shaded areas are the recessions. And sometimes recessions, they come in really three general setups. One is a long one, and it could be a deep one like 2008. Or it could be a very short one and deep, like think COVID. It could be a protracted, not necessarily deep, but just it seemed to never end. So the early 80s or the 70s is another one. Or the 1990s, where it's kind of a rolling recession. So most of the 90s, if you think of the Canadian economy particularly, not a whole lot going on. So technically the recession was during the 1990, 1991, but really the economy really didn't start get going until the mid to late 1990s. So it was kind of a rolling, each sector was going through a recession at a different time. But recessions have happened before, and markets have bounced back from these recessions. But investors oftentimes try to get ahead of it, meaning try to sell off before the recession actually happens. Because remember, recessions are by definition two negative growth quarters in GDP back to back, combined with negative job growth. In 2022, we had the two negative quarter of growth, but we didn't have the positive, or we didn't have a negative or a pullback in the employment numbers. In fact, it was the first time in history where you had two negative quarters combined with positive job growth. So investors try to get ahead of this recession, and so sometimes the sell-off happens in the middle or well before a recession is actually declared. Sometimes it's concurrent. Sometimes it happens so quickly investors kind of get ahead of it correctly. Sometimes you get sell-offs even though there are no recessions, 87, the mid-90s, 83, 84. So investors sometimes get it wrong. But it's safe to say that whenever you see the white line, which is the stock price versus the 50-week average, and when there's a big difference between the two, mean reversion usually happens and the stock market comes back at or below this 50-week average. So the 2022, we saw that basically the market come back to its 50-week average, if you will, which is entirely normal, and that equates from peak to trough to about a 25% move downwards. Now, let's talk about the other villain that people, or investors I should say, are worried about. And that is debt, particularly government debt. So the chart on the right that you see is all the federal debt in Canada in nominal dollars. So obviously that number is going to go up as the economy grows. It becomes more, the economy gets larger, gets more valuable. Think of it as your house. It's or a business. If the house or the asset becomes more valuable, that asset can sustain a higher debt level. And so we had the 70s, and then we had the 80s, and then early in the 90s, Canada went through a debt crisis, and so the debt level of Canada came down in terms of absolute values while the economy kept growing, and so Canada's debt picture, if you will, improved dramatically. But in the past 2 years, Canada's debt has gone up nearly 60%, 57% in basically 2 years. And central banks are deathly aware and afraid of this situation. So think about it. This move up took about a year and a half, 2 years, is equal to most of the move from the early 80s to the 90s in terms of the additional debt. So that makes you think about the actions of the central banks of Canada. And this picture, by the way, is true of most developed economies, the US, most European countries as well. So central banks have a problem in their hands because government debt coming out of COVID or the pandemic have absolutely exploded. And government debt has a problem because it borrows money, or government debt, I should say, creates a problem because the money is borrowed and then recycled into the economy. And if there's too much money chasing too few goods or services, and the source of this additional money in the economy is irrelevant, you create inflation. So central banks are fighting governments who have borrowed money to inject money into the economy. It's kind of like Lucy and Charlie Brown, where you have this external factor that central banks are trying to behave and they have no control over. So interest rates, central banks are trying to raise interest rates our thesis is anyway, that they're trying to get this government debt under control. So if governments have to spend more money on their debt because the interest rates have gone up, governments at some point will have to curtail their spending. And why is that important? Why are central banks trying to get governments to curtail their spending? Labor, which brings us to our other or fourth villain in the economy, or what investors are worried about. So I showed this chart last quarter, and I think it's an important one. So basically what you see here is the growth it's not inflation adjusted, the white line is the growth in employment going back to 2007. And it follows the curve. The slope of the curve is more or less equal to the growth in Canada's population. So it works. The blue line, the blue line is Canada's growth. The white line is healthcare. Again, one of my theses was, well, maybe healthcare spending has gone out so much that there's an employment boom in healthcare. And in fact, it's followed the blue line, so that doesn't square up. The yellow line is manufacturing. And even though manufacturing, the output of goods in the Canadian manufacturing sector has gone up dramatically, the number of people working in manufacturing really hasn't changed since 2007, which really means that manufacturing has gotten way more efficient for each unit of labor that they need to use. And the orange line is government employment, public administration. And that number, starting right around 2020, I should say, exploded up. In fact, it is up dramatically. So what does that mean? Well, it means that as governments added more money or borrowed more money, one of the ways they used it was to hire more people to send money to administer programs. As the government adds more people or needs to hire more people, they're creating labor inflation. And this labor inflation is part of the reason anyway for this, why stamping out labor inflation will be so difficult, because it really will depend on governments curtailing their hiring and in fact even laying off some of their workers in order to get the labor market back in balance, since the government is doing most of the hiring through the borrowing that they're doing. So here's a bonus monster or villain that investors are worried about. Let's talk about inflation for a little bit. So I've got two charts for you. The first one is the chart of the U.S. central bank Fed funds rate, if you will, the rate of interest that central banks charge banks to borrow from them. And really, you can see that, again, investors are used to near zero numbers, but we're just moving back to the 5% number, which, if you look at 5% right here on the chart, if you go back pre the Great Recession, you hit 5% or you hit blue a lot of times if that was your benchmark. So 5% used to be a normal, if not a low rate, going back to the mid-'80s, but that was a high inflation area period where we were coming off a high inflation area, I should say. But let's just agree that 5% is not a high number, and that's more or less what central banks have told us in the U.S. where they want to go back to. And this is inflation, the posted inflation number. So there was a massive spike, which corresponds with right at the time where governments started borrowing a lot of money, where inflation just absolutely spiked. But ignoring this area, inflation has been between the 2 and 4%, going all the way back to the early 90s. And so central banks have announced that they want to go back to this 2 to 3% number. And historically anyway, central banks have always prevailed. Now, Benoit, stop for a minute. You seem to lay out a pretty tough landscape for the consumer with high interest rates, higher inflation, government spending being curtailed, the curtailment being forced upon by central banks. And central banks have typically always won their battles. So the consumer and the general economy is, they're in for a tough ride. Yet you've been more positive on the markets than you've been in many quarters. If we look at the portfolios, the cash balances are down to fairly low levels. And you've just told us that you expect them to continue to be lower. meaning you'll be a bigger buyer going through 2023. That's true. But like any road, we won't expect it to be smooth. We'll have some choices to make. But the direction is it going the right way, and that does not change. Like any motorcyclist, a good one anyway, that wants to survive, you want to be on the lookout for the worst of any obstacle that will derail your perfect day's ride. But you want to be on a motorcycle nonetheless. So you've got to be smart about it. So let's look at some of the risks that we feel are opportunities for investors for 2023 and beyond. So the first one, and that predates COVID, is demographics. Developed countries and their economies, the players are getting older. And that means that the makeup of the economy is subject to change, and so are the spending patterns. Energy. You've heard the transition to cleaner energy and so on and so forth. That was, and that still is the case. Whether we're rather ambivalent in whether the move to a carbonless sources of energy needs to happen, will happen, when it will happen, we're agnostic about it. We're just trying to find sources of profits, but governments have mandated this transition, and so it should not be ignored. Finally, regulations. Governments are more and more, and some regulations is good. Let's be honest. We all want the manufacturers of our drugs, as an example, and medication to be heavily regulated. But regulations tend to slow things down, make things more complicated, and can stifle innovation because it makes it harder for new entrants to come in. And we talked about inflation. The fight for inflation, if central banks want to get their way and they want to get back to the 2 or 3% annual inflation rate, well, they're going to break some eggs. So that's going to have an impact. So let's look at some of the sectors that we feel are well positioned for these. Some people will perceive them risks, but we view them as opportunities. We've got technology, so it could be software and or hardware, but profitable technology. Pharmaceuticals, obviously, and medical devices, older demographics. COVID and the pandemic have taught us that pharmaceuticals have their place in terms of public policy. The energy production, I talked about, whether you're talking about dinosaur bones or renewable sources, the current events and past events of 2022 in Europe have shown us that energy is actually, the access to energy and the ability to produce energy actually dovetails with national security issues. So with that, you've got energy production, or you've got energy services and infrastructure. Those are also sectors that are very, very important going forward. Utilities, the ability to create or generate energy is important. And finally, financials. If you're talking about regulations, well, in most countries, the telecom sector, the entertainment sector, or even the financials are all heavily regulated areas, not to mention utilities and energy production. So those are sectors that we certainly have a keen interest on. And when it comes to inflation, one of the best ways to fight off inflation is actually through brands. So think of your favorite breakfast cereal or your favorite clothing line. Brands are a way for companies to pass on their and keep their pricing power, meaning any input cost they can pass on to the buyer, and the buyer is willingly paying for the increase in price and not necessarily looking to switch out of the product or the service. Now there's a season where people are setting out their predictions for the markets and their what they view the 2023 and beyond to be like. We prefer to think in probabilities. So we've just laid out the case where there may be a recession. We kind of think it's more of a rolling one than a very deep one. It certainly, we don't expect to be a long one in terms of a recession. But we're really thinking in terms of probabilities. It's probably our more most probable outcome, if you will, and we'll weigh the portfolios and the investment decisions accordingly. But we're willing and able to pivot away if unforeseen market changes allow for or makes it necessary for us to make changes to the portfolio. We're not necessarily boxed into a viewpoint or a prediction. As time goes by, more data will come in, and it will either add weight to our most probable outcome or take away and make another possible outcome more probable. When you make a prediction, you tend to box yourself in. You tend to have a very binary outcome, and thus being less flexible. So currently, our most probable thesis, and I'm emphasizing at the moment, is a situation where interest rates continue to rise more towards their long-term averages, but at a more measured pace. We expect an economic slowdown, but the duration and depth remains unclear. But really, as I said, probably a shallower one and a shorter one is what we most probable. That net result is that the consumer will be under duress. The challenge is that there are other potential outcomes that could happen. The economy could not slow down materially. Maybe global growth resumes fast and furious on the back of China coming back online, full bore. Or maybe geopolitical tensions subside. So that would be better than expected outcome, and so your portfolio has to be reflective of that as well. Also, you have to respect worse than expected outcomes. A long and a deep recession, a slow recovery, inflation problems. Central banks don't get their way, and they're difficult to abate. Wage inflation and government spending does not abate, and so the inflation problem continues or even accelerates. Or worse still, geopolitical tensions move from a proxy war that we're seeing to a defined conflict between superpowers. Now, investors, we can't predict the market, but are, in general and in aggregate, are investors pretty good at fortune tellers? What do I mean by that? Because at the beginning of the video, you heard me talk about what's baked into the current stock price. In other words, bad news or good news is baked in, and either it's overcooked, meaning there's too much good news, or too much bad news baked into the current price. So I'm going to attempt to convey this concept here. So what you've got is the S&P 500, the orange line of the returns. So we had, minus 18%. This is all in US dollar numbers. So minus 18% in 2022, plus 28, and so on and so forth. So the returns are quite volatile. They're negative. Sometimes they're heavily positive. And then the next item, or I should say the top item, is the dividend contribution. So as an investor in 2022, and if you invest in the S&P 500, dividends contributed 1.32% of a return. And in 2022, there was also, the blue line represents the earnings growth. So there was good earnings growth coming out of 2021. And obviously 2021 had massive earnings growth because we were coming out of an area, especially in the US, where you had negative earnings growth because the country shut down for basically 5 months. So that's what the blue line gives you. It's that investors will adjust their calibration for what they view the price to be worth for every dollar of earnings based on the growth rate. So if the growth rate is high, investors will tend to want to pay more for growth. And if there's a contraction, investors will kind of pay less for this growth because the growth is negative. Makes sense. Now, the yellow line is maybe the more complicated one to understand, is what are investors willing in terms of premium to this growth? Or what are they willing to buy? Are they willing to pay up for earnings, or are they discounting future earnings? And that's where investors turn into fortune tellers. So what happens is very often you might have earnings growth, but investors already foretold this earnings growth a year prior because they were willing to pay up for earnings that might have been negative during a recession, meaning they are thinking 6, 9, 12, even 18 months down the road. So investors in 2022 even compressed their earnings, meaning what they were willing to pay for a dollar for earnings, even in a year where you had positive earnings growth, because they were really thinking about 2023. In other words, The recession, if and when it happens, investors already predicted that because they were not willing to pay more. In fact, they compressed what they were willing to pay for each dollar of earnings. Whereas in 2020, in the depth of a recession, they were willing to pay up for earnings and pay a 45% premium. Why? Because they knew the recession would end, and they were looking forward to the earnings growth coming out of the recession. So that's what I mean when stocks are either current prices have baked in a lot of good news or a lot of bad news. So thank you so very much for watching. That concludes our video for the fourth quarter of 2022 and the annual review at that. Our goal remains to own great assets, to buy them and purchase them at reasonable prices and limit the risk of the assets we do own by either reduce or even selling out those positions when we view that they're overvalued. Ideally, these assets will pay an income stream along the way, as otherwise known as a dividend. On that approach, quality, not overpaying, managing risk, we remain steadfast. As always, we thank you for your trust in managing your investments, and we're always here for you and look forward to the opportunity to meeting and chatting with you in 2023.